Let's take a look at this report where we're asked to prepare a performance report that would help the owner-manager assess the performance of the company in May. So we have the information in front of us, and what they give us in this problem is for the Exchange Corporation. There's an analysis that's been done of revenues and costs for the month of May, right? So here we say planning budget, unit revenues and costs. So there's been 40 exchanges completed, revenue of $395 each. This was the planning budget. In this column we see the actual exchanges completed and the unit revenue, and then the variance. So we actually had $10 in variances that were unfavorable, and that's because the variance was $10. This is on a per unit basis, or well, it's on a per unit basis. So a $10 variance is unfavorable, $385 versus $395. Then we look at legal and search fees, and we see $165 was the per unit cost of the legal and search fees. Again, this is all on unit revenues and costs, so it's per unit. Actual was $184, so $19 unfavorable. Office expenses were $135 for planning purposes, but came in favorable, $23 lower at $112 per exchange. Equipment depreciation, $2 favorable, right? $10 was the planned, $8 was the actual per exchange completed cost. Rent $45 versus $36, $9 favorable, and then $1 favorable insurance, $5 planned, $4 actual. So total expense, if we add those up, was $360 versus $344, or $16 favorable. And on a per unit basis, that means net operating income was planned for $35, and the actual units cost were $41. The variance, of course, $6 favorable. Okay. So again, the emphasis here in the notes is what you're looking at were unit revenues and costs. So they're telling us that the average office expense is $135. That's this number right here. Per exchange completed on the planned budget, where the actual office expense is $112. And I'm just reading this paragraph in here. Now, legal and search fees is a variable cost, so they tell us that up front. Office expense is mixed. Equipment depreciation, rent, insurance are fixed cost. In the planning budget, the fixed component of office expense was $5,200. So they're giving us little hints on what to do. All right, all of the company's revenues come from fees collected when an exchange is completed. That's another way of saying the revenues are variable, right? We only earn revenue when an exchange takes place. Okay, now I've added this box down here at the bottom to tell us what we need to do to construct the report if we need to put together a performance report, right? So what we need to understand is on a variable cost basis, revenues are $395 per exchange. Q stands for exchange, so 395 times Q. And of course the 395 came from there. Legal and search fees, they told us, was variable. So it's $165 per exchange. And office expenses, they told us $5,200 was fixed, and then we've got to determine the variable portion, and we're doing that by using essentially the high-low method. So we take 135 times 40 minus the $5,200. Well, how did we come up with the 135 times 40? They gave us the 135 as the variable portion right there. Okay? And then they told us we were planning on having 40 exchanges at the 135 unit cost level. So if we take the 135 times the 40, or let me say this another way, 135 times 40 and then subtract $5,200, the fixed portion, and divide the whole thing by 40, we're able to come up with the variable cost portion, which is $5 per unit. Okay, equipment depreciation was fixed, so we know it's $400 because you would take the $10 times the 40 units, and then rent and insurance the same thing. Take the 45 times the 40, and the $5 times the 40. And you've got that information given right here, 10 times 40, 45 times 40, and 5 times 40. So with that information, then we can put together the performance report that we need to put together. Okay, now I've readjusted the screen so that we've got that little block of information that we see here at the top, and the solution is down below. Okay, the planning budget called for 40 units, so $395 times 40 is $15,800. $165 times 40 is $6,600. And you see I'm just working through the math that we've solved up here. The office expense would be $5,200 plus $5 times 40 units. Okay, and that comes out to be $5,400. The equipment depreciation is $400, rent $1,800, insurance, and again that's just what we calculated above. So we had total expenses of $14,400 based on revenue of $15,800. We were expecting to make net operating income based on 40 exchanges at $1,400. Now, what we were able to do is then take a look at what we really did, which was $385 average exchange. So if we take 385 times 50, we come up with what the actual expenses were. Subtract that from the revenues, which was $15,800, and we actually have a $3,950. Well, I'm sorry. I want to break this into two components. We have $19,250 in total spending, and then what we want to do is compare how much of that is a result of an activity variance versus a spending. Okay, so how would we do that? Let me explain that. All right here, $19,250 is a result of the exchanges completed, which was 50, given earlier in the problem, times the revenue that was also given per exchange, which was 385. So 50 times 385 is 19,250. If we had 50 units times the revenue that we planned for, 395, we're going to get a different number. And that number we'll get is 19,750. If you take 50, the actual exchanges, times the 395, the planned revenue per budget, you come up with what the flexible budget would have been, which means what would the budget have been for this level of activity had we used the planning amounts. And then we compare the 19,750 to the 15,800, and that difference is 3,950. So we've got an activity variance that's favorable because the plan. Well, let me see how the best way I can explain this. The 3,950 represents the difference in revenue of what we would have earned given our actual level of activity versus what was planned. So the primary reason that we're favorable is we actually had 10 more exchanges than what was built in the planning budget, and 10 exchanges times the 395 gets us the 3,950. And then we walk through the same chain going down, but let's go across first. If we look at spending variance, we then compare what the flexible budget would have been for 50 units versus what we actually spent. 19,250 versus what the flexible budget called for means we had a $500 unfavorable exchange. All right, and then we go through the same logic for all the other line items. Legal and search fees were $9,200. We get that by taking 50 times $184. Okay, if again for legal and search fees, if we would have used the 165 times the 40 units, it would have been 8,250. So we have an activity variance, which is the difference between the 8,250 and 6,600 that was unfavorable to the tune of 1,650. These are expenses, and this number is higher than that, so it's unfavorable. We actually incurred 9,200, so 9,200 versus that flexible budget level says we were also unfavorable in terms of spending by $950. For office expense, we use the variable port. We actually do it the same way. We know that office expense actually was $5,600, but if we actually took $50 times $5 per quantity and added $5,200, we'd get $5,450, which means a flexible budget versus the budget at the planning level of 40 exchanges, we're $50 unfavorable. But when we compare that $5,450 to the $5,600 of actual results, we're actually $150 unfavorable, right? $5,600 minus $5,450. This number is greater than the flexible budget, so it's unfavorable. Now, there's no variances for any of the fixed cost, right? Because regardless of the level of activity, we're going to have the same flexible budget results. Okay, and sure enough, actual results came in right at the correct amount because these activities truly were fixed, and the cost didn't change regardless of whether we worked or we had 40 exchanges or 50 exchanges. And that's the entire problem. Then, of course, you just add up the total expenses and compute the total amounts and then mathematically compute the variances. And that's how you work your way through putting together a flexible budget performance report for Exchange Corp.